Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Hello, everybody. Coach D here with TackleTrading.com. I was poking around the clubhouse and I saw a question from Eric Biggs about the call ratio backspread that we talked about on the podcast last week on the Trading Justice podcast. And I had meant to do a video on this, and so I wanted to make sure I did that. And I thought I would also use the options report and feature that and just show you how, again, useful and valuable the option report is. Stock reports option. Again, shout out to Grant and Tyler, did an awesome job this week on the stock and options report. And of course, Greg Holmes and Keith King on the commodities report and Forex report. If you're not using the reports, you're really missing out. So I poked into the options report and I was looking at the picks this week. And there's some awesome candidates on the watch list. And of those candidates, one that really caught my interest was the Halliburton. So it also would work very well for this call ratio backspread. So here's the ratio, here's the list here. Nice little list of candidates, and this probably would have worked on any number of those. I particularly liked Halliburton for a couple of reasons. One, I have a strong seasonal bias on that sector, and two, it's a big support resistance zone with a very clear line in the sand. I think there's more upside potential than there is downside risk to that next support zone. So again, using the options report, for the candidates on the watch list, again, ideal for trading option strategies on these picks. That's one of the reasons they're on that watch list, is because they're viable for option strategies. So I'm going to jump over here into the Thinkorswim platform, and again, just kind of show you some of the analysis that made me think that this would be a good candidate. Some of the first things I noticed, again, that big support resistance zone, just to reiterate, that we've got more upside potential out here to $58 resistance. And then the downside risk, I kind of see it being somewhere between that 41, maybe 38 on the low end. But downside risk, I really see not much below $41. So we got some downside risk, more upside potential. And another thing worthy of noting here on the call ratio backspread is that we got a dividend coming out. That's not that big of a deal, but we're past earnings here, and then we got other earnings announcement coming out in April. And it's important on this particular trade that I have a bias on the volatility. Now, the call ratio backspread, or again, this has got a number of different names. It can be a back ratio. There's different ways to kind of twist the words. But the strategy is relatively simple. We're going to sell an in-the-money call and get paid. We're going to get paid a premium for promising to deliver the stock. Now, we don't own the stock. And then we're going to turn around and buy the right to the stock at a higher strike price, out of the money strike prices. And we're going to try to get a ratio of better than 2 to 1. And this one, I think we can get about a 5 to 1 ratio with the strike prices in question. This is not a core strategy. This is a speculative strategy. Now, a core strategy is typically going to be theta positive, and it's going to focus on collecting time decay because that's the one constant in the market. So your core strategies are covered calls, naked puts, credit spreads, iron condors, those types of cash positive strategies. This is going to be a theta negative strategy. It's really a delta vega strategy. It's based off of a directional bias, the anticipation that this can go up, and the anticipation that with earnings coming out, that gives me a bias that volatility should stay high. So that's the base principle here. Now, this particular candidate, again, struck my fancy because from a seasonal standpoint, I've got it set up to a 20-year seasonal chart. And that's telling me that over the last 20 years on average, in the springtime through about mid-May, this stock is very, very bullish. So again, it goes sideways in the summer months. It gets beat up in the fall. But from now till May, and we're going to use some June options, we're going to have a pretty bullish bias on this stock, this sector. So that really, really helps. Between the bullish bias on the stock and on the sector, and seasonality, and the fact that earnings is coming out, we are going to have a bullish delta, and it's going to end up being a vega positive trade. Now, I'm going to go through and show you how I analyze the trade. And first thing I do here is I got June options, more time than I need. And I'm going to look at selling in the money calls. I'm going to sell these 42.50s, and right now I could probably get about 680 out of those between the bid-ask spread. So we can bring in, sell one, get paid $6.80 some odd cents. So now I've got $6.80 in my pocket, and I've promised to deliver the stock at $42.50. Now again, I don't own the stock. I'm going to take that money, and I believe this stock can easily rise out to 57, but these 52.50 out of the money calls are going for about a buck 35 or so. So these are going to cost me, I'm going to buy these. So I'm going to buy those. They cost about $1.35 or so. And if I got 680 in my pocket, that's enough to get me, I believe, 5 of those. So I'm going to end up with a 1/5 ratio. And these in the money options got a delta of about 78. So I'm going to be negative 78 on that delta. And then these out of the money options have a delta of about 31. So I'm going to be delta plus 31 times 5. So it's going to be 31 times 5, 30 times 5, and then minus 78. So I'm going to wind up with a net positive delta. And it creates a really interesting risk graph. Now, if you go look at the risk profile here with me, I've got this laid out for you. And again, you can see that this is the June options. We got the 42.50 by 52.50, so that's a $10 spread. So the risk is going to be $1,000. One contract that I sold, and essentially one of these 52.50s is going to be used to offset that, so the 42.50. So the difference is between those two strike prices, 52.50 and 42.50, and the maximum risk is going to be $1,000, which is basically one contract times $10. So that's the maximum risk. Now that's really only going to hurt us if it expires right here at 52.50 at expiration, and I let it go clear till June, and it happens to be right at 52.50, right at the expiration in June. I could lose the full $1,000. But in reality, what I'm really trading here is this purple line. And the purple line tells us that, hey, if the stock price rises, and again, the faster it rises, the better the trade's going to do, versus if the fast line the purple line falls there, you'll notice that there's a difference in that slope. It increases here and it kind of decreases there. Now, ultimately, at expiration, anything below 42.50 is actually going to end up being an $8 profit. I have paid 8 cents to place this trade. Okay. If it goes out towards that resistance at 57 between now and expiration sometime, on the high end, I could make $1,600. At the expiration value, I'd make around $900. So somewhere between $9 and $1,600 if it gets out to resistance. If volatility increases, that's going to help the trade. If volatility decreases, that's going to hurt the trade. And then the time decay is negative. So let me show you the time decay factor here. So we got a delta of about 76. That's relatively comparative to a in the money option, 2 strike prices in the money or so. And then I've got a negative time decay. This trade cost me about $4.63. That's why it's not a core strategy. And it's got a positive vega of about 38. And then, the idea is simple, that if we're right, the stock price rises over time and volatility increases as we get towards that April earnings announcement. I'm probably going to look to sell this before April because I don't want that volatility exposure to risk. But that's essentially how this trade works, is we sell the one in the money option to get paid. We take the money, turn around and buy the out of the money option. And we give that funny little risk graph here that, again, if prices go down and it ends up heading down towards that $41 support zone and down in that ballpark, we might lose, might feel about $150, $200 risk, but then the time decay will work for us. And at the end of the day, we'll end up walking away, at this case, right now about $10. And then if it heads out towards the resistance zone where I believe it can head out between now and May, we're going to have a really nice upside potential. And we're looking somewhere around 100% ROI if the stock does move in the right direction. The margin requirement on that is the difference. It's the maximum risk. So I'm going to go ahead and send that one in and just confirm and send that. And see if we can get filled on that for the 8-cent credit. And that, again, we get paid to place that trade. And that might take a second to get filled with all those different options and working out the pricing on that. But again, if prices rise out towards resistance, we're going to have we got months for that to happen, clear out till June. But if it drops down and stays down below 40, down in this neighborhood here, we actually will walk away, break even. So that is a call ratio backspread, and I hope you understand that, Eric, and everybody else out there, that you kind of get the general gist of it. And the general rules are you want to sell in the money deltas around 70 to 80, and you want to buy out of the money deltas between 40 and 30. And then you're looking for better than 2-to-1 ratios, and you want to go about 3 to 6 months in time. That is your call ratio backspread.